Good morning, ladies and gentlemen. We will restart our fund view section after a very long interval, just as the market gears up for an all-time high. I'll request the PCI to kindly fire the long-term charts of the Nifty as well as the Bank Nifty. This is as good a time as any to take stock. We are on the first day of July's FNO expiry. The Nifty has been rising consistently month on month since April. So April, May, June as well as March. 4 months of successive and consistent gains have put Nifty at an 8-month high. As far as the 8-month high is concerned, we are now just 400 plus 200, 600 points below the previous all-time high of 26,200 that we saw in September 2024. Take it from me, we are getting ready for a record high and you need to fasten your seat belts. Now let us come to the Bank Nifty. Again, a similar trend, rising for the last 4 months in a row, and the gain on the Bank Nifty is even more substantial, from a low of 47,700 to a high of 57,270. This is a journey of about 3,500 points, all told about 12-13%. The Nifty is also up about 14% since the low it hit in March, and we are headed higher. Now with this background in mind, ladies and gentlemen, you need to look at funds which have concentrated holdings in Nifty and Bank Nifty stocks. Of course, there is an overlap within the Nifty and the Bank Nifty. Many of Bank Nifty's stocks are found in the Nifty as well. With this background in mind, ladies and gentlemen, let's start our discussion on one of the most well-known funds in the market, which is HDFC Focussed Fund. Why do you need a focused fund? See, what has happened in the last 6 months or so, the rally is concentrated on large cap stocks. While the Nifty and the Bank Nifty are headed towards record highs, there is no such thing happening on the small cap and the mid cap indices, because they were beaten down much more between September 2024 and March 2025. So the rally is now large cap focused. So you need to look at a fund which has concentrated holdings of large cap stocks and has outperformed its peers in the longer term. And that's the reason why we look at HDFC Focussed Fund. This is a 5-star fund. It has been into existence since September 2004. So this is 21 years old. And in the past 21 years, each year, the fund has given you a compounded annual growth rate of 16%. It has outperformed many of its peers. It has outperformed the Nifty, and given its focused nature, it has only 28 stocks in its portfolio, tries to have concentrated holdings so that you can enjoy a very good ride. Now, because it is focused and because it's aimed at the large caps, most of these stocks in the portfolio are a part of the large cap universe. When you look at its assets under management, they are somewhere in the vicinity of 19,400 crores, and this is the top 10 stocks have about 53% of AUM. 53% essentially means about 9,000 crore rupees, and the top 5 stocks have about 35% AUM, which essentially means somewhere like 7,000 crore rupees are invested in the top 5 stocks. Now look at the equity holdings. The first 4 are banks: ICICI Bank, HDFC Bank, Axis Bank, Kotak Bank. A little later, SBI also comes. So in the top 7 stocks, 5 are banks. It essentially means that given the rate cut that has happened, given the fact that credit growth is likely to come in far higher, and the fact that banks will now be having a lower cost of funds because the rate cut has happened, therefore this thrust towards banking in terms of the sectoral thread is excellent. If you look at how financials are represented in the portfolio, they are about 40% of the total AUM versus 28% in its own category. So HDFC Focused Fund is overweight on financials. Then let's look at consumer discretionary. 21% of the AUM is into consumer discretionary compared with 13% that is there in the average peer group. When you look at the overall structure, 83% of the AUM, which is 19,300 crore rupees, is into equity and 13% is in cash. Now let's look at what is the portfolio in terms of price to book. It's a very sensible and decent 3.5. The portfolio PE ratio overall is just 23, around what you have the Nifty. Now what is the long term performance of this fund? And this is where a lot of interesting data comes to our view. If you had put in a 10,000 rupee SIP 10 years ago per month, that would have been 12 lakh rupees. That is the initial amount, which has been broken up into 120 months. That 12 lakh rupees is now, ladies and gentlemen, 33 lakhs 75,000 rupees. It is a compounded annual growth rate each year of 19.6%. You see, that is why it makes sense to always do an SIP. If you had put in a lump sum of 1 lakh rupees in the beginning of the previous 10 years, which is 2014, the growth would not have been as substantial. In fact, that is something that I can show it to you. So if you had put in 1 lakh rupees in the beginning of 10 years and you would have wanted to see what the return was, this would have been somewhere in the vicinity of, I'm just using the calculator just for a moment. Yes, the return would have been 16.7%, actually 16%. So that is the beauty, ladies and gentlemen, that you have to put in a SIP. Overall, you make more returns. So the CAGR return of the fund from the very beginning is 16.5%. But if you do a SIP, that return increases to 19.7% because it buys the dip every time there is a correction in the market. So this is the overall performance of the fund. Now let's look at how this HDFC Focused Fund fares within its own category. If you look at the 10-year return, it's at 16.1%, as I had mentioned. It's beaten its index as well as the flexi cap category handsomely by 200 basis points. And if you look at how the 7-year return has happened, it's 18.5% per year. The 5-year return is 30.1% each year. That's, ladies and gentlemen, something to be really proud of, because in the last 5 years you have seen COVID, you have seen all sorts of tariff tantrums, you have seen Balakot, you have seen the Iran-Israel war, you have seen the Israel-Hamas war, you have seen the Iran-US war, so many other problems that we have seen, the tariff tantrum, Donald Trump's election, yet each year the fund has returned 31% CAGR. Now let us look at how this fund stacks within its category. So from it is always in the upper quartile, which means that if there are 50 funds in the sector, it will be in the upper quartile. For the 5-year period, HDFC Focus Fund is ranked second in a category of 48 funds. For a 7-year period, it is ranked 6th out of 37 funds, and for a 10-year period, it's ranked 5th out of 32 funds. So that, ladies and gentlemen, shows you consistency in managing various volatile periods. What have been the best and the worst returns as far as 1 year is concerned? Well, in September 2013 to September 2014, the fund appreciated 93% in 1 year, and the worst return has been a fall of 38% between March 2019 and March 2020. So when it falls less than what it rises. That's the beauty of a mutual fund, and when it rises, of course, it extends its gains. What has been the worst month? 17% lower between March 2020 and 37% lower between February 2020 and March 2020. This is the COVID phase. So these are downturns and upturns that happen, but at every point of time, the upturn percentage is higher than the downturn fall. So with this, ladies and gentlemen, you should look at creating a very strong Nifty and Bank Nifty focused portfolio for 3 reasons. One, we are headed for fresh record highs in 2025. You have a very, very smart upfront 50 basis point cut that has happened by the RBI just a month ago. Before that, there were 225 basis point cuts. Therefore, the cost of funds, the cost of borrowing for banks is coming down. It also means that their bond portfolios will do extremely well. Public sector banks in particular, SBI, is sitting on lakhs and crores of worth of bond portfolios and government securities. When rates fall, these prices of these bonds rise and the banks book treasury income, higher other income. So keep that in mind and look at this fund from the point of view of not only looking at a fresh record high in 2025, but over the next 5, 7, 10 years, benefiting from how credit will explode in India and how private sector banks are best placed to play that. A focused portfolio is a portfolio which is consistent of less number of stocks. So these are concentrated holdings and they do extremely well in times when the market rises vertically. All that you have seen is data that is collected from various websites. This is not an invitation to buy or invest into HDFC Focused Fund, but merely an attempt to show you quality products available in markets at relatively decent valuations. Should you want to get into HDFC Focused Fund, it is essential that you take an independent advice from a mutual fund advisor. And as always, each fund should be a certain percentage of your overall portfolio. In the case of large caps, which is represented by this fund, it cannot be more than 40-45% of your overall portfolio. Thank you for watching. I hope you enjoyed this fund view.